Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark examines the hot topics from the financial world. Real estate consultant Ross Kay says new government rules for real estate will just make things worse.
Vancouver has set a record price crash in the history of North America.
And Ross will also have some tips for people who either plan to buy or sell a home. And Mackie Research's Payton Nyquvest runs down the Canadian equity markets. We'll talk to Ross Clark right after this.
GEM International is a new diamond explorer in the richest diamond-producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109-carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
We're chatting with Ross Clark. He's an investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Good to be with you, Jim.
The S&P is probably near its peak, and they're going to have a tale to tell us in about a week.
Well, everybody's thought we've been at a peak for so long here that all summer long everybody thought it was the peak and we were going to drop. And, I was always of the mindset that, the break would be in maybe that 5 to 7% bracket. Well, so far we haven't even had that. And next week we do have the opportunity to have some market moving action, at least for individual stocks. You've got 175 of the S&P's 500 stocks will be reporting earnings next week. So that'll be the, quote, peak of the earnings numbers that are coming out. Whether it has anything to do with the outright level of the S&P becomes questionable. But, as we've talked about in the last couple of weeks, it's a lot about sector rotation and what's going on. The biotechs, healthcares have been under pressure, I guess in particular since the Hillary effect started to take hold, and if anything, those two sectors are starting to look pretty interesting right now. The banks made new highs on the year, so the bases that we see in those big U.S. banks still would give us the potential for pretty good upside action.
We know the Canuck buck is tied to oil, and right now the Canadian dollar isn't doing that well, with oil doing relatively well.
Oh, yeah. The middle of the week, here you had the oil market pop back again nicely, back over $52. Canadian dollar gets a nice bounce in the middle of the week. You had Polos from the Bank of Canada in there having his interview. And, bottom line was that for all that commodity prices have had a lift, they're still not seeing much in terms of the Canadian economy. Retail sales are still poor. Inflation is below expectations. The Bank of Canada has probably still got another rate decline on the table. And so with this, you had a little spike up in the middle of the week as far as the Canadian was concerned. By Friday, we had dropped a full 2 cents off the high. We're closing at the lowest level that we've seen in many, many months. And as we've been saying, if the currency can't do well when the commodities are doing well, I hate to see what's going to happen here when commodities start to give back a little bit, in particular as far as the energies are concerned. And when we look at the price of oil, and we look at the price of natural gas, the commitment of traders numbers, which measure the speculative and commercial positions in the futures contracts, for both natural gas and crude oil, they are at levels that we have not seen for over 2 years. There are more people speculating on the long side of crude oil now than there were when we were at $100 and everybody thought we were going to 200, or when natural gas was at its peak. So anytime that you see extremes in these COT numbers, it means that the markets are vulnerable to any piece of negative news. And we did a piece of research this week looking at natural gas prices and the effect that were seen by the La Nina and El Nino out of the tropical Pacific Ocean. And, this time last year, we had a El Nino effect that was at an extreme, one of the highest levels that you see. And these are cyclic activities. They don't come out of the blue because of global warming. They are clearly cyclic activities that happen. So we had a very strong El Nino last year. We're now into a La Nina phase. So this is the cooling of the Pacific Ocean. And when we look back at natural gas prices historically, and this is important right now, they tend to rally out of the summer into a mid to late October high. And we've seen natural gas prices double from $1.50 up to $3.20. So we've had the appropriate rally. And when we look forward now, and this is also why we were talking about gassy stocks in the summer and why they would be a good play, I think it's now time to take money off the table because we should see a good hard correction in natural gas. But by the time we get to the end of the year, first part of January, you can be looking to load up again because the move from January in through the end of the spring next year is one of the most reliable periods in a La Nina year, looking at all the pieces here. So from January through June, I think people should be looking to be overweight once again in energies after taking money off the table now.
Ross, have yourself a pleasant weekend.
I plan on it, Jim, and you too.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy, Vancouver. Coming up, Ross Kay next on This Week in Money.
Always consult your investment professional before making any investment decision.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is real estate consultant Ross Kay from the wealthyhomeowner.ca. Welcome back to This Week in Money, Ross.
Thanks a lot, Jim, and thanks for having me back.
I guess the first thing we should talk about is an update on the BC housing market. What's happening in BC?
Well, in British Columbia, province-wide, you are now into your third month of both a price correction and declining sales. You really don't hear about that from the Real Estate Board of British Columbia, or BCRE as it's called. But that's the reality out there. Right now, when we're looking at your data, we're looking at about a 19% drop in the average selling price of a home in province-wide across British Columbia. Now, of course, a lot of that is predicated on the drop in Vancouver, but this is an inarguable with our data. There is no way to avoid it. It will end up showing up in your nationals or your National Korea or B Korea or Real Estate Board of Greater Vancouver or Real Estate Board of whatever, or the Internet National Bank HPI, months later than what our forecast or what our data shows. But right now you're sitting at about a 19% house price correction. Now, to put that in terms, there are about 4.5 million homeowner occupied homes in British Columbia, and they have all, in terms of appraised value, will take about a 19% hit. So you're talking a devastating impact that has already taken place that no one has reported on right now, and they won't in a while. I'll leave it to the economists to do the math with a 19% drop off the $700,000 average selling price on 1.45 million homes. When we look at this a little tighter, since you asked about British Columbia, we can scan right into at more of a granular level into Vancouver, and in Vancouver's case, although the price drop in Vancouver is still in the 19% range right now, we're looking at a 19.4% range for Vancouver. Of course, the magnitude, the number of dollars that has been lost is far greater. So you're starting off with a peak price in Vancouver that, let me just scroll over as I'm talking to you here, Jim, so then I'm stating the correct numbers. We really time Vancouver, we keep pretty good track of, so that when people ask us a question, we've got an answer. So Vancouver now off peak, you're looking at about 19.7%. So there's a 19.7% drop in the selling price there. When we're looking in terms of the dollars, your post-August sales. So in other words, from August forward, excluding the first 7 months of the year, but from August after, your average selling price in Vancouver, is somewhere around $884,983. Now that's our calculation on the housing stock. Your number from the real estate board is going to be even lower than that. Your number from the real estate board post that term is around the $450,000 mark. But using our numbers, what that means is since September, the average selling price has dropped 13%. Since the first half of the year, in other words, from January till June the 30th, to where we are today, the homes that have sold since, you're looking at an 18.4% drop. And then off peak, our peak pricing to us was in the first quarter of 2016 for Vancouver, and you're at a 19.5% decrease. What needs to be understood is that decrease is $214,000 for the average home. It is a staggering amount of money that has been withdrawn from homeowners' pockets in a rapidly short period of time.
What kind of an impact are the new mortgage rules having on the scene in real estate?
Well, the new mortgage rules, as we had said on an earlier show, I believe, they have already started to have an impact in the market, exactly as we in Ross K. Realty Consultants, had proposed. There is not another forecast out there that accurately told consumers what was going to happen. I've heard crazy reports being released by Canadian bank economists, the government, they just don't make any sense when you understand how a home selling infrastructure operates in Canada. We saw this weekend, so this weekend, we saw a surge in sales that took place in key municipalities across Canada, where the new mortgage rules were going to impact the borrowing power of people shopping. Somehow, those people were conned into believing that you need to rush out and take advantage of the old qualifying rules before the new qualifying rules come in, so you could buy a more expensive home. It just made no sense that kind of advice was being given to Canadians out there. But that's what was being given, and the results right now show us that in the first 3 days of this month, post, which we record from closings from the previous month, like deals that firmed up. In other words, they firmed up to beat the change in the mortgage lending rules. They're up about 13% already in those 3 days. So that is a number that just doesn't happen unless there's an outside factor. For people in British Columbia, and you can look at the foreign buyer tax. So when the foreign buyer tax was being implemented, all the lawyers and the realtors were running around trying to move August closings into July. In other words, they wanted to move them ahead of when the tax came into effect on August the 2nd, so they could close at that time and not legally be responsible for the tax. What we have seen already here in the first 3 days of this week is that, sure enough, in the last week, or, before this new mortgage lending rules came in, there was a surge in buyers who bought homes. And it is not a seasonal surge. It is simply a surge caused by these new rules. So since we were right on that statement, and since we've been right on our forecast with everything to do with British Columbia, I would hope people would listen to us here and understand that now the secondary fallout is that little tiny surge that was reported is now going to be wiped out because those sales were simply kicked forward. So we will see a reciprocal drop of 13% over the next week and a half where those sales are wiped out, and then we will see the real fallout of these mortgage rules come, which is what we expect will be falling prices even greater. Remember, right now, Vancouver is off 19.5% off peak, and it's off 18.04% off the first half of the year. That's what's happened already. British Columbia is off 19% off peak. That is already happened. Sometime early in 2017, what I just told you will be reported by the real estate boards. The benchmark price will start showing up this kind of a decline. The Terranet National Bank will be showing this kind of decline. And the real devastation that's been taking place will be seen. What's concerning for British Columbia in particular is Ontario has not been foolish enough to implement the tax, you might notice. And I was for the tax, just not how they implemented it. The same as I'm for these new mortgage rules, just not how they were implemented, because they were implemented in an irrational manner that is in no way rooted in the fundamentals of how a housing market functions. You're looking at an even bigger hit in Vancouver. And anyone who didn't think that a 40% house price correction in Vancouver was possible is probably going to see one way, way quicker than we could have ever imagined. I want to say one thing before we leave this topic. Vancouver, I'm going to stay on Vancouver because the rest of the province thrives on what happens in Vancouver. Vancouver has set a record price crash in the history of North America. There has been nothing anywhere in recorded real estate transactional data that shows this kind of a collapse of the housing market. When we scan across and we look at the housing market sales volumes, so I've already told you the collapse in price. The collapse in price, which is a consequence of falling volumes. When we look at your Vancouver sales in February of this year, Vancouver sales were running at about a 36% gain over the previous year. In the short period of time, 7 months, you are now running at 67% of last year's numbers. Everybody must remember, the government has said that even at the peak time of closing, not solds, closings, which was July and August, which is the culmination of sales recorded in February, March, April, and May, you're only looking at an 8% of sales going to foreign buyers. But you dropped from a 36% year-over-year gain in sales numbers in February to a 67% of last year's September sales. So that little tiny 8% of foreign buyers in no way can represent that kind of a change. The withdrawal of the market is from the residents of Vancouver and the citizens of British Columbia themselves. And that's why you're seeing these massive house price declines take place.
You're listening to This Week in Money. I'm Jim Goddard. We're speaking with real estate consultant Ross Kay. Ross, what's the housing update for the whole nation?
Well, when we click to Canada, I'll click to that right now. What's really amazing about our national numbers is the fact that even in the public space, we have, my firm has publicly gone out and given some of our proprietary information to the public and to economists and to banks and to the government to review. Yet they are ignoring the reality of the housing market. What I mean by that is British Columbia's share of the market was so strong earlier this year that it was causing an accelerated national average selling price to take place. That has moved to a trickle as of September. And in September's gains alone are fully upheld by the province of Ontario and nothing else. When we're measuring housing markets, we measure housing markets, as I've always told you, not on a 30-day window. We measure them on a 365-day window. We measure them from the buyer's side. We don't measure them from the seller's side, because there is no such thing as a seller's side measure of a housing market. It's always buyer's side. Seller's side measure, you could say inventory. So the number of houses that were actively for sale that could be purchased in a given month, that is one number on the seller side that you actually can use. All other numbers really work from the buyer's side. You have to know how they interact. You know how to break them down to the granular level. You need to know how to compare them against government data for mortgages, CMHC insurance, insurance data. There's a whole bunch of the different data points that we compare them against. But most of those are all but really the number of houses that were for sale in a given month do we track for sellers, for the seller. All of our measures are all buyer side. So what that means is that we track each month where the buyers are buying and what impact they're having on the average selling price. We look at this over the long haul. So when a single home sells in Canada, it can do two things to the average selling price, which will in turn do two things to the average net worth of the average Canadian homeowner. It will increase it or it will decrease it. When we're looking at the market, we're always looking to see are the prices on a single sale being inflated or deflated higher than what the average has been since 1985. So yes, that's right. We look at the housing market from 1985 to September of 2016, and it's continually updated each month. We know what the average home has done when it sells to the average selling price from 1995 forward. We have an index called the House Price Growth Index. And what it does is it tells you the impact of a single sale on the average selling price. So I'll explain it to you this way. In January of 2016, in the city of Vancouver, every single home that sold that month increased the average selling price by $5.55. That is a Canadian record of mammoth proportions. And I'll get back to it in a second to explain to you how mammoth that impact was. But before I get there, let me look at August of 2016 in the city of Vancouver. In that month, each home that sold reduced the average selling price by 58 cents. This is a $5 swing in what the impact, well actually no, excuse me, it's a $6 swing, over a $6 swing in what the average home that was sold impacts the average selling price. This is why there's so much confusion out there about how average selling prices work and how housing bubbles form. When I go to the national level, I look in January of 2016, each home that sold across Canada raised the average selling price by 13 cents. In Vancouver, it was $5.50 for each home that sold. In Canada, it was 13 cents. In August in Canada, for each home that sold, and there was 46,985 of them, each one of those homes raised the average selling price by 3.5 cents. In Vancouver, it was a 58-cent drop. So when I'm talking about January in Vancouver, a $5.50 per home sold, you know, we're talking at from 13 cents nationally to $5.50. I can't do the math in that one in my head, but you're looking at what's that? 6 times 5, 30. You're looking about 32 times. Vancouver's home prices were increasing at 32 times what the national average was. We measure housing markets the way they function. Every single house that sells either raises or lowers the average selling price. It's cyclical in how it happens during a trading cycle. Vancouver set a record at $5.50 per sale in January of 2016. Nationally, in August of 2016, it was only 3.5 cents for each sale.
We'll have more with real estate consultant Ross Kay next on This Week in Money.
Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the 4th largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with real estate consultant Ross Kay. Ross, the CMHC has issued a red alert. What does that mean?
The red alert. So 2 years ago, the Central Mortgage and Housing Corporation started with the HPAA, House Price Analysis Assessment. And they called it a framework where they could predict what areas of the country where the housing market was in trouble. It was a response to, I certainly believe, had something to do with my firm's communications with CMHC and our accusations that we made public about their misuse of data in terms of defining a housing market. That being said, they ran the HPAA for about a year and a half, and then when they found out that we were laughing at it, they magically rebranded it, and now it's called the HMA, or Housing Market Assessment. I don't know if anybody's ever created a report and then rebranded it within not 18, I think it was within a year in the government, every Canadian government history. I'll let your listeners look into that themselves. The fact of the matter is it's now called Housing Market Assessment. The Housing Market Assessment is a stale-dated piece of data or a piece of analysis of the housing market that in no way reflects how a housing market is functioning. Vancouver's housing market, I suspect, well, I guess Eric Siddell, the CEO of CMHC, has already said, you guys have a red warning. In other words, you folks are the worst housing market in Canada. would be a red warning, and Vancouver has a red warning. But this red warning was issued after you've already gone through peak price and your housing market has already crashed. Why did the government not issue a red warning a year and a half ago? Or worst case scenario, why did they not issue this red warning in the first quarter of this year when you reached peak price? At that time, you've got to remember, your housing prices were increasing at over 500% quicker than they normally increase. Why did they not issue it then? Housing prices in Vancouver have crashed. In British Columbia have crashed. We're talking about a 19% decrease already. And now they're going to issue a red warning. Not only that, now they're going to issue a red warning for Toronto and the entire nation of Canada. Now, when I talk about absurd when it comes to bad housing market data, this red warning is going to exemplify it. Housing prices in the province of British Columbia have collapsed by 19% since the first quarter of 2016. Now they're calling it a red warning. Alberta housing prices are following a traditional housing correction where they basically stay flat for a long period of time and allow inflation to eat up. We call this stagnation. In other words, housing prices are stagnating. What's stagnating is because housing prices are a buyer's side measure of the market, is the average selling price. Of course, people are getting about 28% more house for their dollars in 2016 in Alberta than they did back in 2014. Yet the average selling price has only been reduced in that same period of time by about $8,000. But the government gave them warnings earlier. The province of Quebec, and this is the biggest joke. Now you got to understand, the government is issuing a red warning for Canada. Quebec has the second most number of homes owned in Canada of any province. Ontario is the only one that's bigger. Quebec dwarfs every other province. Their average selling price in the last year has only gone up $5,000. Yet they're going to issue a red warning. So let's see. I've just discredited Quebec, just discredited Alberta, just discredited the data that they use for British Columbia. So the only one left is Ontario. And yes, Ontario has increased in value. And right now, Ontario, you're looking at about a 12.8% year-over-year gain as of September. Now, that is too high. There's no question about it. It's unsustainable. An average selling price of basically $518,000. There's not enough income in Ontario to support that. The same way that I said earlier on your show that there was not enough income in British Columbia and Vancouver to support the housing market. So there had to be something else happening. In Ontario, it's a little bit different because regular Ontarians cannot support those selling prices, but those in the upper income levels can. So there is only one market left, one provincial market, where the housing prices are still growing, and that is Ontario. But in most of Ontario, housing prices have been correcting there now for 3 months, except for the way that the Toronto Real Estate Board releases its data. And since CMHC and the government, you can go right to their own reports. They pull the TREB data right off the TREB data, filter it this year now for the first time through Haver Analytics, and then puts it into their charts. It is the exact same number. They're calling a red warning. Real estate boards release sales marketing materials for their members. They do not release real estate data, or they do not tell you how you can read it. Now, in all fairness, real estate boards themselves can't read their own data because there's economists who have never sold houses for a living who don't know how to read the data themselves. That being said, this red warning is coming when every province but Ontario is already in a crash, British Columbia, stagnation, Alberta, which means underlying house prices are declining, and Quebec, which is not even maintaining inflation rate. Their prices are not even increasing with inflation. And they're going to issue a red warning. What they're doing effectively, in my opinion, is covering their rear ends for 10 years anyways of bad data, bad intelligence, bad recommendations to the government. They have people in these positions who cannot even explain how a housing market works. And they're going to make national headlines on the 26th. But what's going to happen this time? What's going to happen this time, Jim, is that we're going to be there. And what I just told you, we will have available in a report. We will not let Canadians be misled in this manner. Our members and the wealthy homeowner have had this information for over a year. We have had red flags on buying in some parts of this country now for 18 months. The only people we recommended buying during those periods were speculators. In other words, if you wanted to get in and out of the market, you can use our data to do that. But if you're a regular old homeowner, it doesn't make sense to do that. That only makes sense for speculators. We've known this for over 18 months. Here we are in October, and it's going to be almost Halloween before CMHC says, whoa, wait a second, it's a red warning. And we say, wait a second, your red warning's useless. The market is already correcting everywhere but Ontario, and Ontario's coming right on its heels.
Ross, if a person is about to sell their home or buy a home, what kind of advice would you give them?
Well, selfishly, I'm going to say they should be signing up for the wealthy homeowner and taking advantage of the buyer and seller programs because they cost them nothing. Aside from that, I'm going to give you two pieces of advice. Now, you're going to still need to know your local market, provincial and regional, and then city, and then specific to your own property or the property you're looking at buying. I would not buy real estate anywhere but Quebec, maybe Manitoba right now. I would not buy real estate. I would continue where I am. If I'm renting, I would continue to rent. I would watch the market, and when the signals are there that the market is shifting, then I would get into it. It makes no sense to buy a house in British Columbia when your house prices are crashing. What professional real estate person in their right mind would tell someone, a family, to go out and buy an asset that you know is decreasing in price each and every day? I couldn't do it. I left the business back in 2010 because I looked at the damage potential that was going on. I could no longer tell people to buy a house when I didn't believe the fundamentals were there to support it. I moved into the field of consulting where it doesn't matter if I sell or not. I just give you the honest advice. You make up your mind. We created the Wealthy Homeowner Program based on that. In terms of selling, if I am 60 years old and I would have sold in Vancouver, probably would have listed my property in the end of February, maybe 1st of March, and I would have got rid of it. That's what I would have done. I would have did that anywhere in British Columbia. Our members all were given that advice. If I am under 60 and I plan on owning my home for another 20 years, I probably wouldn't worry about it too much. Because this correction, it is possible that it takes 15 to 17 years to work itself out. There is so much loss that is taking place right now. We are looking at decades of mortgage payment, or more than a decade of mortgage payments at today's, even at today's low interest rates, to recover from these losses. A housing correction, the length of it, generally is measured, how we measure it, how long it's going to be, is how long it's going to take existing homeowners to recover the equity that they've lost in the crash. So if you're under 60, you're planning on owning a home for the next 20 years, I'd probably just sit with it where it is. Of course, my advice is also would technically cause further correction in the market to happen, and with more volatility and at a quicker rate and at a higher amount. Regardless of that, this is how a housing market functions. My recommendations are not going to change it. It is going to happen anyways. You need to take a defensive position.
Now, of course, the Bank of Canada is hinting it may drop interest rates perhaps in the new year. How would that affect mortgages?
Well, first of all, I firmly believe that with these new rules, part of the reasoning for these rules, which that no one has disclosed from government or the Bank of Canada or anyone, but I believe interest rates are going to drop. What they did is they stepped in and they put these rules in at the worst time possible. They should have put them in 3 years ago. When you miss that opportunity, you've got to wait for the cycle to work itself out, and then you've got to bring them in at the bottom of the cycle again. They didn't. They've taken it at the peak of the cycle. So I think that they did that because they need to stimulate. I'm not an economist. What my economist professionals have told me is that this is a way for, if the government wants to stimulate the economy, is to lower interest rates. Historically, lowering the interest rates has allowed consumers to borrow more debt because their homes have become worth more money because the housing market accelerates. That is no longer the case. I believe we will have seen October will be the last month nationally of positive house price growth. That trend will now move negative. British Columbia is negative. Alberta is negative. Quebec is flatlined, which means it's negative. Those are your four key provinces representing 85% of the Canadian housing stock. It's all you have to measure to know what's going to happen in the economy. I think you're going to see lower interest rates. It will do nothing for the housing market because if they lower the interest rate by a quarter, the posted rate, which is the new qualifying rule, will only decrease by a quarter. So instead of being at 4.64%, it's going to drop to, if it drops a quarter, it's going to drop to, 4.39%. The qualifying difference is marginal. In other words, you're not going to be bubbled to buy much more house. The interest rates change that little tiny bit in there. So I fully suspect we are going to see lower interest rates, but that will be, once again, to the advantage of the corporations and the banks, because there are other consequences from these rule changes that are going to come into play. What I would recommend to all of your listeners today, this is free advice that is worth thousands of dollars to anyone with a mortgage. Contact your mortgage broker tomorrow. Get your mortgage renewed or locked in at these historically low interest rates. The reason I say that is because I believe the spread between the posted rate and what the banks are offering is going to be reduced because the banks no longer have the pressure of competition. Well, we can get into this discussion after the November the 30th mortgage rule changes come into effect. But what I believe is it only makes logical sense that the banks who are going to lose profits on a shrinking real estate mortgage debt because the houses aren't going to keep selling are going to, in turn, use the spread, which is currently sitting at, in some cases, 2.7% between the posted rate and the rate that they're offering on a 5-year term, and they're going to shrink that. If they shrink that, historically, that rate has been down at 1%. It's at 2.7% now. If they even do half of that, just half, you're looking at a 0.85% increase in your mortgage over a 5-year term. Get a hold of your mortgage broker, see what your costs are, get a pre-approval. The worst thing you do is get a renewal rate with a lock-in for 120 days.
Ross, thank you so much for talking to us here on This Week in Money.
Thanks a lot, Jim.
My guest has been real estate consultant Ross Kay from the wealthyhomeowner.ca. Coming up, Payton Nyquvest next on This Week in Money.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Payton Nyquvest, Vancouver investment advisor at MackeyResearch.com. Welcome back to This Week in Money, Payton.
Hey, Jim. Thanks for having me.
How did the senior markets in Canada do this week?
The TSX had a high of 14,956. Low was around 14,583. Closing at 14,939, up about 353 points for the week. The Venture Exchange had a high of 791, low around 772, closing at 790, so that's up about 14 points for the week. And the CSE, Canadian Stock Exchange, had a high of 817, with a low of 781, closing at 801, down 6 points for the week.
Payton, what was driving the markets in Canada this week?
It continues to be the resource markets really continue to be the driver, especially on the venture side. Along with marijuana, which I know we've talked about, it's been very busy the last little bit. And you're seeing a little bit of action in the healthcare sector as well, but still continually being led by the resources.
Now, I know in the U.S. that the marijuana producers are having trouble getting capital because the banks still look at them as being very suspicious. Same troubles here in Canada?
Well, we're still trying to figure things out from, how the industry is actually going to be run. Right now, these larger MMPRs, which are legal grow operations of medical marijuana, aren't recreational, so they don't really qualify for the same issues that a lot of the U.S. marijuana companies do, as they are a recreational product as opposed to a medical product.
And of course, too, they can't trade this across state borders. It's just in their own state, isn't it?
Right, because it's not federally legal yet, just on a state level.
Have you heard any chit-chat about any problems with marijuana investors in Canada or the U.S. and U.S. federal authorities?
I haven't. I haven't heard of anything coming up in terms of that yet. We're keeping our fingers crossed that it doesn't, but time will only tell, right?
Now, junior gold producers have had a great year so far, up until now, with people investing money in them once again, but are folks now getting a little nervous with maybe perhaps another major correction on the way on the stock markets?
Gold, I think the general consensus is that gold's probably going to be okay here. It did have a pretty good correction down to about $1,250. It's since rallied up kind of 15, 20 points since then. And I think a lot of people, especially with the election coming up, I think a lot of people are kind of looking to gold as one of the kind of leaders here over the next little bit.
Canada's diamond miners, how are they doing?
They're doing really well. I know we've talked about Mountain Province, but they continue to hear good things out of that camp. I'm expecting to see some first production numbers out of there fairly shortly, but the general consensus is that should be a big leader in the diamond spaces, and as well as Stornoway, which should be paying a dividend here shortly as well.
Uranium prices have softened up lately. Has that discouraged more exploration for uranium in Canada?
It seems to be a bit of a waiting game there. I think you're kind of at a point in uranium where, you need to see a rally to happen for especially in that northern Saskatchewan area. You need to see a rally in the uranium price before companies like Fission and NextGen can kind of get to the next level. And then you need to see that happen for the exploration guys to start really getting out there and being able to spend some money on exploration projects as well.
And, of course, in Canada, the winter season is quickly approaching. And, in fact, way up north, it's already here. Is that a factor when it comes to exploration?
A lot of the companies up in that area, whether it's, uranium, diamonds, it's actually easier to operate there in the wintertime because it's easier to get around on ice as opposed to kind of a bog that sits around in that area. I know there's a couple diamond explorers like Margaret Lake Diamonds that is waiting for the ice to hit there and plans to, hopefully get out drilling in March. And it's kind of the same thing for uranium coming into winter as well.
Payton, thank you so much for chatting with us.
Thanks for having me.
My guest has been Payton Nyquvest, Vancouver investment advisor at MackeyResearch.com. That wraps up our show for this week. We'd like to thank all of our guests, Ross Clark, Ross Kay, and Payton Nyquvest, and thank you for listening. If you have any questions for us, you can email us at info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of How Street Media Incorporated. Executive producer is Tom Allen.